The dollar just had one of its biggest two-day moves in about a year. And what this is threatening to do is unwind one of the biggest short positions in the history of the market. And here's the frightening part. This is what concerns me because key levels are already being broken. And what this is setting up for is a massive correction. So get your notebooks out because I've got all the key levels you need to see. We're going to take a look at the dollar, the broad market, bonds, gold, the VIX, everything. Because I don't want you just to protect yourself if this thing unwinds. I want you to make a ton of money trading it. So let's start out. We're going to take a look at this chart of the DXY. Now this is right off of my trade screens. So this is something that you can set up for yourself. And what I want you to see over the last 6 months that the dollar has largely been trading in a range. And all of a sudden, you see it jumped yesterday, and then today it came right up into what a level called resistance. Now, how do we know this is resistance? Because in this case, you can see this is where sellers have showed up several times over the past 6 months. Now, the risk is here. If we see the dollar break through this zone of resistance, and here's the first thing you need to put down in your notes, I'm targeting 100.4. That is the last line of resistance because if we zoom out, let's take a look at a 2-year chart here. What you can see, there's a quick move up to the 102, 103 range. And if it gets squirrely from there, this whole thing starts to unwind pretty quick. Now, I understand. You're saying, Steve, I'm not really convinced here. Fair enough. Let's overlay a chart of QQQ here, and I think it will really help you understand the correlations we're seeing between the dollar and the market and why I'm so concerned that this short trade starts to unwind, that everything goes with it. Because the narrative behind this trade was real simple. Everyone believed the dollar was going to go down. So what do? You borrow as many dollars as you can get, you short the dollar, and then you go buy risk assets. So let's overlay this chart of QQQ now. And so I'm just going to go in here and I'm going to add a study, and we're going to put in QQQ. And we've got a purple line. So this is perfect. So QQQ now is showing up in purple. And what I want you to see is the dollar and tech stocks, well, they traded actually in the same range. But you get to somewhere around April, May of last year, and what happens? That relationship breaks. And all of a sudden, you see the short dollar trade really come into play. It's kind of funny because Jamie Dimon suggested that the bank was starting to get short like a month ago. No, you were short almost a year ago here, but you can see the trade. It makes perfect sense. The dollar stays weak and tech stocks go up. So that is the real issue here. You see every dollar rally here. Look what happens in tech. It sells off. So that's the concern. And one of the reasons why we're not seeing tech rally here has everything to do with the dollar. So how do you trade this thing? This is let's start with the first piece of this. Well, one, you can go long dollars. The other side of it is you can go short euros. So here's the next thing I want you to put in your notes, because this is right from Bank of America. This is based on their latest CTA report. $1.1663. We'll just say that. I don't know how to put that in dollar terms. And I've got that chart right here for you that I want you to see. This is the US dollar to euro spot rate, or EUR/USD chart on your trade screen. And there's that red line, $1.1663. That's your number. You break that line, and what happens next is the CTAs are going to start dumping euros. So that's the key point. So you want to keep an eye on that to see if this trade is going to start to unwind. Now, another way you could look at it is you could take a look at UUP. And this is a pretty easy trade. This is a broad market ETF. Let's first clear off this QQQ overlay because we don't really need it anymore. And let's go find where I've got UUP here. Here it is. Now, you may remember maybe last week or the week before, I was talking about how the technicals from the chart perspective, it looked like the dollar was going to go down. It was running into resistance against this 50-day moving average here in green. And this is a bearish signal because when you get a cross of a moving average to the downside and then it can't break through it to the upside, well, that is a very bearish signal. Now, I know somebody saying, well, Steve, you got it wrong. Well, I didn't know there was going to be a conflict in Iran. And in this case, what you see is a flight to safety here. Now, if this conflict continues to go on and there's still concerns that people are worried and they go to safety and they go to the dollar, now you've got the catalyst for this thing to unwind. And you've already seen initially the equity markets are at risk here. So if you're looking at the dollar, and we've got the 6-month chart here, you've got resistance up here around 28.20, but look at the 1-year chart, and this is pretty interesting. Now this red line here, If you're not familiar, this is called the volume profile line. You see the volume here on the side instead, and what's on the bottom too in Cayenne. But what this tells us is the price level that most of the shares were traded, and it broke over that 1 year mark. So a lot of people over the last year have been buying up dollars, and now you're starting to see the initial phases of the squeeze. But if we go back here real quick and take a look at that DXY chart, there's something important I want you to see. Because again, how do you know you've got your support and resistance levels right? Because sellers came in right as it got up into that zone. So I want you to be thinking here, for all the people that are in that trade where they borrowed dollars, they shorted the dollar and they're long the market, they've got to defend it, because if this thing unwinds, well, they've got to buy dollars, they're going to sell stocks, and next thing you know, this whole thing comes unglued. Now, let's take a look at the next thing we've got, because I want to get into the QQQ here and get a little more detail, because I've got a ton of levels for the broad equity market you've absolutely got to know about. So let's start out, let's go right up here to QQQ. And we've got the volume profile line turned on. Now this is interesting because you can see right below that purple line where my mouse is, that's the 1 year volume profile. So what does it tell you? All the people that are saying the market only goes up for the last year, you could see, at least in this topping range, there's been a lot of people selling. Now let's zoom in, because here you see the 6-month volume profile is right at the same level, confirming, as I've been saying here for months, that this is starting to look very toppy. But there's something notable, and I'm going to point it out, and then we're going to get into why this is happening. Is every rally you'll notice is getting sold. So as we look at today's chart, you see buyers came in. Typically, we're seeing a lot of retail activity here. They came up and they bought, and then sells off by the end of the day. If we look at over the last 10 days, you see the same thing. Rallies get sold, rallies get sold, rallies get sold. The question is, why is this happening? Well, part of it is machine positioning. The other part of this is dealers. So one of the key things we want to first talk about is the moving averages. So as we go back to the chart here, we've got the 100-day moving average in blue. We've got green is 50-day and 21-day is in red. And notably, it crossed below them and it's had struggling to get back and reconfirm them. Again, these are bearish signals that we can go back and look the last couple of years. You see, every time a major index rolls over, it's confirmation that it cannot recover one of its moving averages. So that's one of your key points. Now, let's talk about what's going on with asset managers here, because they are super long. And I want you to understand that there's a lot of people that are along the market here. So we've seen asset managers very, very long the market. So again, you start thinking about this trade coming unwound, there's a lot of people that are going to have to sell. Let's take a look at hedge funds here, because as we've talked about in the past, their gross leverage here, this is looking at their longs and the shorts, they're sitting around 220%. So you put this in perspective of your portfolio, you've got $100,000, they're leveraged out 2.2 times on that. That is a ton. But here's one of the key things. They haven't backed off on their short positions. But what they have done is they backed off a bit on their long. So in the midst of this, they're trying to unwind some of their leveraged long positions. They're trying to do it quietly here just to get out as much money as they can. Now let's talk about those CTA positions here. Just get your notebooks out, because you're going to need to see this. Let's take a look. Key pivot levels, I'm going to show you all the charts on this. 69.06, this already broke. Here's the next level, 67.52. Now, why is this critical here? Because this is where some of the biggest selling from these machines hit. So if you get a close below that, again, 67.52, you got to have that in your notes, put it on your chart. That's the next wave of selling from the machines. Now that lower level, it's a long ways away. It's sitting at 63.41. Now, if we start to trigger this midterm level, you can see over next month, we could get 170 billion of selling. This is global equities. This is right from Goldman Sachs. So let's take a look at the charts here. Let's go back and look at the S&P 500. And I want you to see what's going on, because this upper purple line right up here, and I can make it a little bit bigger if that helps. Let's make it a 3. Now, this is the short-term trigger level. So if you've wondered why everyone that was buying in here, and we do know the data says this was heavy retail buying, why did it get rejected? Because what happened is when we got to close below that purple line, the CTAs began their initial selling phase, and they were selling over this whole wave right here. So now we're sitting below the 6-month volume profile. You can see it there. And now this is the midterm level. That's the next key level. You see today it traded below it, but the most important thing is the CDAs don't sell until it gets a close below it. So that is your next critical level to keep an eye on. Now let's move on, because again, we got to talk about some more important things here. We've got funding spreads, dealer gamma, puts, we've got it all, and I need you to see these charts. So let's go back over here and take a look at funding, systematic macro. I forgot to add this chart. So this is great, because when we talk about machine positioning here, one of the biggest risks we have is the machines start to sell. And there's a lot of different machines. There's vol control, there's risk parity. And what happens is one layer of machines start to sell down, it starts to trigger more. And what I want you to understand is these machines are pretty long here. So if you look at the total global equity position, again, this is US, outside US, you take the CTA, the trend followers. These are the ones that kind of react first. Then you have your risk parity, vol control weighted, and then you have your vol control strategies. You can see historically, going back, to 2018, they're really long the market here, suggesting, again, if we start to see a move down here, if the dollar rallies and stocks give up their strength, we're facing a big potential unwind. So let's take a look at funding spreads, because this is where you see leverage in the market. You see a lot of leverage players here are starting to get out. So funding spreads are in black. This is kind of proxy, again, of where you see people taking leverage in the futures market, and you can see it against the S&P 500 in blue. The key thing here I want you to see, downturns and upturns, they're generally led by funding spreads. So right now you can see a lot of leveraged players, just like the hedge funds, they are pulling their positions out, suggesting there's a potential unwind in the market coming here. Now, another issue we've got to deal with is gamma. Now, if you've been wondering why that every day there's buying comes in and all of a sudden it just kind of runs into a wall, it's the dealers. So they're in a negative gamma position, meaning any kind of rally, they have to actually sell into it. And this is key, because their gamma position, it doesn't start to free up until 6,600. That's a bit of a ways down below that CTA trigger level. And if we get below 6,800, the dealers are going to sell even more. So that's one of the reasons here we're seeing this kind of topping pattern. Is I want you to understand that there's a lot of people that are already have been selling. The machines started to sell, and the dealers continue to sell into every position. Now this can accelerate, particularly as we go into options expiration date later this month, because check this out. Now, I want to give you the bullish case here, because even if we do see a sell-off here, I'm not predicting an end of the world, financial crisis, 50% meltdown. I mean, who knows? We might see 20 to 30%, maybe just 10 or 15. But here is something you really need to understand. This is the short position on the S&P 500. And you can see, going back to 2010, it's never been this big. So here's what this is telling you. If we see accelerated move of the market going down into options expiration, that means these options are going to be worth more. So in turn, the dealers are going to sell more. Now here's what's really key though. When we see a bottom start to happen, if this thing unwinds and we start to see a bottom, it's going to be as all of these puts come off. It's kind of the idea is people are going to sell off their insurance and go back in and buy the market. Now, if we don't get a sell-off, and we start to see people walk away from these puts, so maybe at expiration people don't roll them over, well, that tells us that this unwind of the dollar, it's not going to happen this time. Doesn't mean it can't happen again in the future. It just means it's not likely to happen. Now let's talk about what's going on with oil here, because my subscribers, we made some money on this trade, and I think there's a lot more on this. Now on Friday, our report told our subscribers to buy USO. This is our CTA Time Pro report, where we trade the machine position like I'm showing you here. It had an expected win rate of 59%. Now at some point today it was up almost 7%, but as of the moment, it kind of pulled back a little bit. Let's take a look, because you remember yesterday I said, look, if you're chasing oil, don't go chasing it without a lot of protection underneath. Our report said buy it here. Our subscribers are up. We'll be looking to raise our stop loss level as well. So if you're looking to trade the markets, if you want to catch these swings, we've got some great reports. We trade momentum, we trade machine positioning, just like I'm showing you here. And here's the best part. I'm going to give you a 30-day free trial. So you can trial the report, no obligation. All you need to do, hit those links in the description below and be sure to use your coupon code for your free 30-day trial. Now we've got to talk about something important, something near and dear to most of you. It's called gold. Now, let's pull up a chart of gold here real quick, because I've got the CTA trigger levels for you. And if you're long gold, if you're a little concerned here that it dropped today, silver was down over 8%. If you're concerned and you look at this chart, I don't see a lot of things that could be worried here. You see the volume here? There's plenty of volume. And if we take a look at the 90-day chart, that's not it. I think the 90-day was there. There's plenty of support down here underneath it. Even over the last, say, 30 days, you see it just dropped down to its 30-day support line. That's where buyers stepped in. Now, here's what you need to know. If you're trading this and you're long and you're worried about the CTAs unwinding, well, oh, I guess I should have overlaid the chart so you could see it. I was looking at it, but here you go. Here's that 30-day volume profile. The joys of being live is sometimes you don't know where your camera angle is at. And there it is. So here is the CTA level that you need to put in your notes for gold. If you want to know when they sell, 4,701. Again, it's 4,701. Not even a concern at this point. If you're long gold or you want to buy more gold, if you think there's a lot more upside, if you're worried about CTA selling, you can take that one right off the table. All right, let's talk about the bond market here. I know there was a comment about that. Let's pull up the chart and take a look at the long bond. And let's click back over here and the long bond, there it is. So today it rallied right back up into its 6-month volume profile. It got rejected there. It did pick up support at its 100-day moving average. Keep in mind though, if you think in this case where we're going to see the dollar strengthen and bond prices go down, that can happen, and that's the initial move here, because people look at oil and they say, okay, that's going to be really inflationary. Until you start to realize that as consumers see their energy costs go up, their discretionary spending goes down because their pay is not going up to compensate. So you get an initial reaction here by the market. You hear the Fed start to worry about, oh my God, inflation might show up. We're going to be on hold. Everyone starts to get excited. And they say, wait a minute, maybe this is kind of a little bit overblown. And I think that's the case here in the market. Now let's talk about those trigger levels on the CTAs, because we've got that here for you. And what you can see is, other than the 2-year, and this data here is from Goldman, where they see flows likely heading down even on a small move lower, you don't see any movements on the 5-year, 10-year, or 30-year unless there's a down big, and that is the red line. So right now, this latest move, not really a down big move. Now, one of the concerns here, if you see this happen, if we see the dollar and bonds rally, that's not good. That is a massive risk-off move here. Now, I want to talk about the VIX because it does come into play here with the dollar. So as we tie kind of everything back together, we can see that everything right now in the markets is keyed around the dollar. If this trade starts to rally, a lot of things have the potential to come unwound. But what about the vol structure here? So let's go back and pull up that DXY chart. What I want to do is overlay the VIX, because this is another thing. If you're saying, I'm just not convinced that the dollar makes a big difference here, well, it really does. And so let's zoom out, and we've got the VIX here in purple, and I want you to see periods where the dollar, here's the DXY, is going up. It puts upward pressure on vol. And you can see the two have been fairly tightly in sync since when? Right around April, May of 2025. No surprise, right? Again, the banks are denying, saying, well, we haven't been shorting the dollar. No, you have been shorting the dollar, and we can see that you've been doing it, and we can see that investors have been doing it. But the key thing here is periods of a rising dollar typically come with rising volatility. So you can see, kind of the big picture here of how this thing potentially unwinds. Now, again, I don't know if the dollar is going to unwind. The risk here is if this conflict continues on and there's a further flight to safety, I want you to understand what's coming here. Because when we talk about trading, again, let's kind of overview how you play this. You can be long the dollar, short the euro here, but you're not going to make a ton of money on it. The dollar goes up, the bank stocks are coming down, so you want to look at that. You could look at high yield bonds. Those are all positions that you could look to be short here, particularly if we start to see private credit continue to have some issues. The long bond, I really want to see it reclaim that 6-month volume profile. How about gold or silver? From the gold to silver ratio, silver over gold. But as we've been talking about, it's super volatile. So you've got to have the stomach to get through that vol. Otherwise, right now, gold looks like the safer of the two in terms of the least amount of movements. But if you're trading silver, again, just be prepared. There's going to be days like today where you're going to enter a position and then it's going to drop maybe 8%. So you've got to keep your stop losses tight. You've got to keep, your initial, when you put a trade in, your limit orders, you got to keep those tight because you're looking for the upside move. You want to try to control that downside. We know with silver, the daily volatility is somewhere around 6%. So now you've got the setup here. You see why I'm so concerned about this long dollar trade and how it's unwinding. If it does, now you've got the recipe, the playbook you need to protect yourself, but more importantly, profit. And with that, I'm Steve Van Metre. Appreciate you joining me today on the live stream. I will see you probably tomorrow. Bye now.